Good day, everybody. My name is Murray Anderson from Ashburton Investments. Welcome to our conversation today. I'm running an interview with Albert Botha, our head of fixed income portfolio management, and we're going to be talking about income funds, and particularly flexible fixed income funds, their dynamics, past, present, and future. Welcome, Albert.
Thanks, Murray.
Folks, would invite you to ask questions on the system, and we will go through our discussion and take questions at the end. But please post them as we're chatting so we can build up a bit of a library, and then we'll go through them at the end. The intention is for the conversation to last about 30 to 45 minutes, and we'll just see how we go. But in preparation, I've put forward a couple of questions in trying to journey us through the fixed income markets. But I think a very good way to start is actually to talk about the industry evolution. So Albert, I'll just position the way I see things, and then I'll ask you to color in the technical bits and pieces. So over the last number of years, and in fact I go back to sort of the last 15 years, we've seen quite a substantial evolution of the fixed income market in South Africa from a funds perspective firstly, and then secondly, I guess, the instruments that one can use to populate those funds in accordance to the ASISA mandates that they have. And maybe that's a nice way for us to start in terms of money market funds, how they are positioned today, and we'll move across the categories in the fixed income space, and then we'll delve more deeply into what to expect from the flexible fixed income funds, and particularly the Ashburton Diversified Income Fund. So maybe just talking about money market, and obviously this is all in the context of us sitting at home interviewing one another, and the trappings of COVID-19. And the market dynamics around that. So, Albert, you maybe just want to start off talking about the money market space for a short period of time.
Thanks, Murray. So, money market funds have been with us now for decades. Right? The original fixed income funds in South Africa were broadly money market funds and bond funds. And the purpose of money market funds have always been as a safe haven and as a source of liquidity. And that's actually been one of the few categories that have been broadly unchanged with those types of dynamics for the last 20, 25 years. What you can buy in a money market fund, how they're positioned, those things have shifted around a little bit. But the broad purpose and how money market funds are viewed have been like that now since the late 90s. You buy a money market fund for short-term liquidity, for a short-term safe haven, for a very, very conservative investor. Corporate clients use them for the same reasons. And for a lot of clients, specifically clients that quite often sit in bank deposits, the money market fund is the first step out of a traditional bank deposit product. So it's the first step from, to use the industry parlance, from an on-balance sheet product to an off-balance sheet product. The first step into the regulated collective investment scheme space.
Okay, so you talk about an off-balance sheet, which is into the asset management world, and naturally people were making that progression because interest rates in your typical bank accounts was kind of just not enough for the longer term. And when we talk about longer term, we're actually talking about the next 3 to 6 months in the cash sort of holding space or parking space. Now, just linked to that is obviously we've come through a very high interest rate environment in South Africa, and now rates have been cut fairly aggressively to accommodate the need for funding, I guess, or to ease the pain in terms of what we're experiencing in the COVID lockdown and people's certainly their financial position. So the easing of monetary policy has meant that interest rates have come down, and therefore the returns that one expects on money market funds have come down in tandem with that. And that obviously poses a bit of a concern for people. So maybe just commentary around the journey of interest rates and what it means for money market funds like this.
So you're completely correct. That journey of interest rates actually goes back to the late 90s, early 2000s, when interest rates in South Africa were close up to 20%. And then effectively from then on to now, we have been in a declining interest rate environment. Now, that's been true not just in South Africa, but across the world. But in the mid-2000s, 2005, 2006, clients could get pretty close to 9-10% on a money market fund. And then suddenly in 2009 and 2010, suddenly money market returns were at 6%. From where we are now looking forward, money market returns are likely to be around about 5% for the next 12 months, right? It's approximately 1% above the average repo rate for a period, right? It varies depending on underlying conditions, but that's a rough rule of thumb. So the lower repo rate falls, and we know we've seen a declining repo rate environment for the last 20 years in general, not consistently, but in general. And money market rates have fallen in line with that. And as that developed, clients started looking for alternatives, right? And the problem was, for a long time, the only alternative was the bond type space. And the bond fund there's a big difference between a bond mandate and a money market mandate. So the industry started creating these various other types of funds that try to fill that gap between what you can get in a money market fund and what you might be able to get in a bond fund or a fund with a lot of equities in it. So that's the underlying dynamics that's been driving investor behavior and their fund selection for the last 20 years.
And the search for yield created the innovation in the industry. So I guess now we're going to step up to the stable income fund environment, and the way you do that is the inclusion of other assets. But before we get there, I just want to point out that the Ashburton Money Market Fund is now set up to hold money market paper excluding corporate paper. Okay, so that means that it's obviously well positioned from a risk perspective. But now stable income fund, to deliver the repo plus return that you've spoken about, needs to include additional assets. And there we've stepped up into the corporate world. So maybe just in terms of that, we understand the money market positioning and interest rates there, but to get that higher return, you've needed some additional pickup out of other assets. So maybe just talk about the corporate space and particularly the dynamics that have been taking place in this COVID lockdown period.
So you're right. The money market fund uses the big South African banks, big 5 South African banks, as well as AAA rated international banks in the portfolio. But with interest rates falling, people started looking for an alternative. The previous low in interest rates was in 2009, 2010. And the Ashburton Stable Income Fund was actually launched at the beginning of 2009. I've been managing that portfolio since September 2009, in fact. And it was created specifically for a time when interest rates were low and falling. And it was created to try and give you about a 1% above a money market fund. Right? Because if you think about interest rates and return dynamics, stable income is likely to give you about 1% above money market. But when interest rates are, let's say, 15% in a money market and 16% in stable, that additional 1% isn't that valuable. When interest rates are going to give you 5% in a money market and 6% in a stable income fund, suddenly that additional 1% yield represents a 20% increase in returns. And it's very valuable to the clients. Now, to get that, you need to start taking additional exposures and additional risks. Now, the two primary things we do in stable that we don't do in the money market fund is we add additional term. So the weighted average term of all the instruments in the money market fund has to be, by regulation, lower than 4 months at all times, right? 120 days. The stable income fund doesn't have that restriction, and currently the weighted average term is about 2.7 years. The other change that we've made is we add a little bit of corporate credit, so non-bank credit. And how much is in there varies over time depending on our view of the overall credit markets. And towards the end of 2019, we've been reducing that overall credit exposure, not because we were prescient and thought the COVID crisis were coming, but the additional returns that we saw on non-bank corporates just didn't really justify taking significant risk outside of that space. So we've been reducing corporate exposures. And when the COVID crisis started, we were sitting on about 25% non-bank credit exposure. Now, as you've mentioned, Mary, there were some risks during this time. We saw a liquidity squeeze in Land Bank that led to them undergoing a technical default.
Sure.
That meant that their credit paper now, rather than trading at 100 cents on the rand, are trading at 90 cents on the rand. You put that into perspective, that's pretty similar to what happened to African Bank senior debt in 2014. Right? We also saw liquidity squeeze for the big banks. In other words, people were looking for things to sell out of their portfolios, and the only things they could find buyers for was the big 5 bank paper. And the buyers of that paper was in a very advantageous position, and were capable of, let's say, negotiating the price down, which led to credit spreads increases, which led to a little bit of a volatility increase in stable income compared to what we got used to expect. Now, thus far, we're positive year to date. March, April, and May were all positive months, but the return over that period was lower than the average return we've seen, say, for the last 5 years.
Sure, and that, as you say, it was an extreme period. I mean, whether we call it a 6 or 7 sigma event, first sort of pandemic in over 100 years or so, this is extreme stuff that we'd seen across all asset classes. So I think one can understand that, this is, as you said, some people would say they could foresee something coming, but by and large, the entire industry didn't see it at this scale. So one can be forgiven for, the extreme movements around, asset prices. But I think the point you make is very valid around the judicious allocation of corporate, starting to, on the back of probably what was looking like a tough economy going into COVID-19, reducing exposure, but importantly, a very strong credit process to manage the credit exposure we've got. And I think now, just maybe a thought on slowly easing lockdown, economic activities improving, and obviously you'd expect, that to deliver some relief in the corporate space from a pricing perspective. So maybe, is corporate paper fair valued at this point? It had probably been compressed for the search for yield. We had a little bit of a retreat, and now, when things normalize, taking corporate exposure again is probably at, in the right names of the right credit quality. It would be an interesting asset class to review and look for some potential future returns.
Yeah, so you're right. There's certainly the opportunities at the moment. The reality is that your participation in those types of opportunities will vary massively across the type of mandate that you're investing in. Right? Stable income has never been, and will never be a swing for the fences type portfolio.
Sure. And that's governed by its mandate.
Yes, it's governed by its mandate, by the client need. As I've said, I've been managing this for a decade. I've got a pretty good idea of what the clients want from that portfolio. You need to provide R1 billion of liquidity in and out of that fund. So picking up lots and lots of credit for stable income is not something we're doing at the moment. What we have been doing is picking up small credits where there is really significant mispricings in the market. But by and large, until we have more certainty, specifically in the South African corporate market, to what degree South African business activity can recover, not this month, but in August and September and October, then we'll have more certainty, and then we'll look to be adding credit to that process. And if there's one thing that Ashburton is very, very good at, feeding off the strength and the DNA of the parent organization as well, is credit origination, credit analysis, management, pricing. And it's something I think that we are extremely good at. We've got a very strong credit team and a very strong credit process. So it's very likely that when those opportunities come along, we'll be in a position to take advantage of them and be able to be judicious about which ones we select.
Sure. Okay, Albert, thanks for that. So let's just move up to sort of the old asset classes that outside of money market. You spoke about bonds, but there was this income sector, and those have been around for many, many years. And there it was really, again, just an extension of the money market stable income space where you were permitted to use some duration. Now, I think that sector kind of fell out of favor for many years, especially when diversified income funds came to the fore. And I'm really talking about early 2000s. I remember our own colleague Arno Lorenz launching one of the first flexible fixed income funds in 2003, and that was in the industry saying, look, there are other instruments available. Let's broaden the mandate and allow investors to have access to these. And it was almost an extension of the time horizon for fixed income funds to be used in client portfolio constructions for pre- and post-retirement exercises. So maybe just if you can talk into SA income, and then let's start moving into diversified.
So to understand the income category, the income restrictions, you kind of have to delve back in history again. The All Bond Index duration at the moment is pretty close to 7. If you look at the duration where it's been sitting this year, it was between 6.5 and 7.5, depending on when you looked. However, in the early 2000s, the duration was closer to 4. And money market duration is close to 0. So when they said, well, we need an alternative category to kind of house this thing this income need that's kind of not quite bonds and not quite money market, they created a category called the income category. And the Orbi duration was pretty close to 4 at that time. So they created a category with a duration limit of 2. Right? Now, duration is a technical term. It just means sensitivity to interest rates. But what was effectively said was this category will be placed halfway between bonds and money market. And it was supposed to be you use a lot of the money market instruments, but also some of the advantages in bonds. At the moment, that category actually houses 2 types of funds. One is the stable income type, enhanced cash fund that Mary's already spoken about. And the other one is your traditional old style income funds, which have evolved to be something like stable income, but with a little bit of bonds, a little bit duration trading over time. So it's supposed to be stable income plus a little bit of duration risk. So you take stable income, you add a little bit of bonds and a little bit of bond trading. And that gets you your old traditional income portfolios, of which Ashburton SA Income is an example.
Okay. So diversified income fund then now includes a broad spectrum of potential fixed income asset classes. So I think we need to dig into those to give the viewers and listeners insight in terms of how we position, what to expect from the fund. So let's just build up. So you've been managing flexible fixed income funds for over 7 years now. And more recently, we launched the Ashburton Diversified Income Fund. And naturally, building a multi-asset income fund, you would look at the various asset classes and on a risk-adjusted basis, build your allocation. Now, I think, what was great to see is that into pre-COVID, the fund was doing well on a relative basis, delivering the kind of return you'd expect from a fund like this for your retirement and post-retirement income needs. And then, lo and behold, we had, as we mentioned earlier, this 100-year event. And obviously, all asset prices around the world were highly correlated, and we had massive drop-off. Now, naturally, Diversified Income Fund, if you look at the return series, felt foul of that. So what I want you to do is, if you don't mind, just talk to the positioning pre-COVID, and then we'll dig into the dynamics of those various asset classes and what you've been able to do to get back to in delivering performance post the bottom of like 24th of March. So, yeah, over to you.
Okay, so as you mentioned, these funds, they used to be called fixed interest varied specialist funds, right? And you could invest in a range of fixed income asset classes, which at that point in time included property, bonds, money market, preference shares, and then those same asset classes both in South Africa and offshore. And then a while ago, with the reorganization of the CISA categories, that entire category got reorganized into what's called the multi-asset income category. Now, the multi-asset income category is, except for the money market category, the largest category that we have in the interest or fixed income space. It's about 4 times as.
Just out of interest, that's now sitting at the quarter 1 data of 2020. It sits at 217 billion in AUM. Yeah. It's 11% of the industry.
Yeah. It's almost 3 times the size of the bond category. The only fixed income category that's large is the money market category. So it's a very important category within the space. The interesting thing about those funds is that now recently they can now use any asset class, right? But there are restrictions on how much they're allowed to use. So, for example, they are allowed to use equity, technically. The problem is, or the reality is, that most managers in that space don't really use equity in the sense of they don't buy the all share, they don't buy the S&P. They use most of the equity allowance to buy preference shares, and occasionally a guy might buy a 1% equity holding here and there. They're allowed 25% property. In practice, however, most of the funds sit way below 10%. And then you can buy bonds, inflation linkers, as I say, preference shares, and all the same asset classes offshore. That category is effectively the the category that you can use to run a fixed income fund in almost any way you can dream of, right? So it's used quite widely by people to run very, very high yield or high risk credit funds that has a specific type of audience. It's used to run very, very quantitative portfolios. And then it's used to run the types of portfolios that we tend to run, which is more of a multi-asset income type portfolio. So in that fund, we utilize all the asset classes that I've mentioned. And up until effectively just a couple of days before March, we were still very comfortable with the since inception performance of that fund. The reality is that we went into the COVID crisis slightly overweight risk, I think, compared to many of our peers, and that certainly hurt us, right? So we held a slightly overweight position in bonds. We were relatively neutral property, and we were relatively neutral preference shares. Many other portfolio managers in this space don't use preference shares, for example. We were relatively underweight linkers, but even the inflation linkers, but even at the holdings we had, all of those asset classes were down significantly, right? So we saw the SA 10-year bond go from pre-crisis levels at a little bit below 9% to the close on the 24th of March was close to 12.5%, right? So bonds sold off. Property sold off. That property was down at one point almost 60%. I think it was 55%. We had about 3% property in the fund, which meant that you lost close to 2% on your property holding, even if you only had a little bit over 3%. Same thing with preference shares. Preference shares were down 30%. Right, so those were some of the things that hurt the fund going into March. Right now,
so even though you had, so sorry, just to interrupt, but even though you had smaller allocations, given your view for the next 2 to 3 years, the extreme nature of the sell-off was actually the impact that one saw.
Yeah.
And
yes,
to get
also,
that, and sorry, just to finish that thinking and to get that outperformance above stable income fund, that's the mix of and the percentage allocation that one would require over time to deliver the kind of return that you were looking for, hence the position.
Yes, I mean, diversified income since inception up until February outperforms stable income, anywhere from 1.5% to 2% per annum, right? So it's supposed to be your entry level into a relatively high-performing income solution. That, however, does come with some risks, right? Sure. What that means is that when you hit a crisis like this, there will be some drawdown, right? And the entire industry suffered drawdowns. Ours was admittedly a little bit more than we would have liked, and admittedly a little bit worse than some of our peers.
Sure.
But unfortunately, or maybe fortunately, you can't judge a portfolio on its worst point. And it's now been 2 and a bit months since the drawdown, and we've actually come back very nicely with the portfolio giving you pretty close to over 5% if you look at the performance in April and May.
So in what was a very difficult period, obviously, as you're saying, you've managed to, through, I guess it's judicious allocation of assets within the portfolio and probably some opportunistic trades. Maybe let's just, if we can sort of do a bit of an attribution of that last period. We know it's short-term for the viewers, but as you say, it has been in relation to the competition in this space, a fairly outstanding performance. So maybe let's just help people understand what took place post the 24th of March to get you back into this position.
Okay, so there were, let's call it, 3 different primary components, right? Okay. The first one is the pullback in the market, right? So the pullback in the market has helped everyone. Without a pullback in the market, obviously, everyone would still be where they were in March, right?
Sure.
The trade relative to our peers, 2 things helped us there. One is a lot of the hedges that we use in the portfolio, both on currency and on bonds. We use a range of options to hedge those positions, and the reality is that those options add value over time. They reduce your day-to-day volatility, but the full hedged effect is only seen over time or at maturity of the option. So part of that was a lot of our hedges that we put in place working and giving us additional performance over that period. And then lastly was the types of trades that we did during this crisis. Right? So we looked around the market and we said, well, what are the things that we think that you should be buying, and at what levels do you buy them? What kind of macro calls do we think should add value? So, for example, if you look at the initiation of quantitative easing in 2009-10 and that build-up, one of the asset classes that did very, very well out of that was gold. One of the first things we did was we bought a little bit of gold for the portfolio in the downturn, and that added a bit of value, right? So there was a lot of purchases of things, and I can detail them if you want.
Sure, but I guess the standout one was the fair value of the bond market at the time, with the view that the Fed's going to come in and throw the kitchen sink at the broad U.S. market and subsequently the rally, and I guess other global central banks coming to the same position, and then sort of the stimulus we've seen in SA has meant that recovery was quite sharp and nice. So you needed to take the opportunities there. But I guess from a valuation perspective, it was one of the standout asset classes. And when you think about the funding requirements from an SA perspective, there's a lot of dynamic in there. But obviously, that was one that helped substantially, I would think.
Yeah. So I think there's a reality that is important here, and it's that every asset has a price for which you should be willing to buy it. And depending on the type of asset, it's generally traded relative to others. So if you look at South African bonds, the primary factors influencing the price of South African bonds on a relative pricing basis is your US bond yields, right, and your money market rates locally, and the price of other emerging market bonds globally, right? So those are your primary three factors that influence your bond rate from a relative peer analysis, right? So if you want to get those kind of returns, you can either buy South African bonds or Brazilian bonds or something else. Or you can decide, what, I'm going to buy US bonds, but I'll do a CDS trade. I'll sell a CDS on a specific other country, and you can build up a range of assets returns in that way. So there are various ways to get a return decomposition and a relative pricing for any type of asset. And the last factor in South Africa from a macroeconomic point of view is inflation. And when you look at all of those things, you say, well, the US 10-year is trading at the lowest level that it ever has. Right? It dropped down to 0.3%, 1% at some point. It's currently trading at around between 0.5 and 0.7 on a day-to-day basis. Not that long ago, it was trading well above 2 to the 3% range. If you look at South African inflation, the first printed inflation this year was above 4%. We are expecting inflation to print anywhere close to 2% next couple of months. And in the repo rates were dropped by to over 2.5% in the first 5 months of this year. So if all of the alternative or base asset classes and yields and prices have adjusted in that way, there's a very strong argument to be made that bonds can't trade too far from those kind of levels. You can't have, just to use an extreme example, US 10-year bonds trading at, let's say, 1% and British bonds trading at 50%. That gap doesn't survive contact with reality. The same thing is true with South Africa. Given the underlying dynamics in this country, there is still a connection between your base rates or your asset alternatives and where you buy the bonds.
Okay. So maybe just a question around then, so predominantly an SA-biased fixed income fund with, your permissible allocation offshore being what it is. Just I want to give a sense to the viewer and the listener, what's your range for offshore exposure? Because obviously built into that then is some volatility that is inherent because of the currency, and you spoke about hedging. So maybe just talk about the extreme allocation, what you're comfortable, what neutral would be, and then just recap on hedging that currency, because obviously we've seen the rand come back to 17 at this point.
Yeah, so you always have to start with what the mandate allows. The mandate technically and regulations allows 30% offshore. Very few people actually run it at 30%. the balanced funds and those kind of guys do, but the income funds generally don't, because you're right, it adds a little bit more volatility than most people are comfortable with. As we speak, the offshore allocation is around about 20%, and that range of that 15 to 20% range is likely to be our range going forward. One of the things I would have liked, obviously in hindsight, is to have more offshore exposure going into this crisis.
Sure.
I think everyone was like,
because you had perfect sight about COVID coming at you.
Yeah. But yes, that 20% is 15 to 20% is kind of where we sit or should sit on average. And then if you look at the dollar position, the offshore position, most of that is hedged almost all the time. Right? There's something interesting to say about how people should take offshore positions, but most of the research seems to indicate that in one way or another you should apply some hedging to your offshore positions, and then how you hedge that is up to you.
Okay. So we've been through quite a bit of detail now, so I just want to kind of bring it back and just conscious of time and maybe a few last questions from my side. So going back to the return expectations for, let's just look at recap on money market, stable income fund, and then diversified income from this point, 1 year forward, given what we know to date.
So we try to aim for specific numbers, and they're easier to estimate on money market and stable income because they have base rates. So as you said, money market should give you approximately between 5 to 5.2% over the next 12 months. Stable income should give you about 1% above that. So let's say 6 to 6.2, right? SA income should be, so historically, SA income was about 0.5% above stable income. So if stable income would give you 6, SA income should give you 6.5. However, with as steep as the yield curve is now, that gap should widen as well. So let's say if stable income gives you 6, SA income should give you 6.5 to 7. And then for diversified income, we'd like to aim for around about 8% for the next 12 months. So 8% plus for the 12 months going forward. But that is going to be, that's a little bit of a difficult task from here on out. Partly because a lot of the repricing in the market, where we could expect significant upside in the bond space, for example, has happened. Right?
Sure.
So we spoke about how the bond yields have gone from, the 10 years gone from 12.5 to 8.7 as we speak. Right? So that is a massive rally. That rally can't be repeated over the next 2 months.
Sure.
So the yield expectations on diversified income is likely to normalize, but the same things that will add value to the SA income fund will add value to the diversified income fund as well. And then the other thing that diversified income fund does have still is we are still in the process of seeing some of the benefits of the hedges we put in place coming due, both on bonds and on currency. So it is likely to outperform SA income, and let's call that again by about 0.5% to 1%. So let's say we'd like to, if a year from now we got 8% on diversified income, we would be very, very happy.
And I think if you position that against where, sort of, as you say, repo is and what you can get out of your traditional call rates, that's a pretty reasonable return. So maybe just to close off then, we've always talked about sort of your bucket strategy, but within the fixed income world, money market being conservative, so your first step out of the bank space for clients that want, high level of protection. Stable income for the next 3 to 6, 9 months. And then, as we've expressed in this conversation, diversified income fund would be for your sort of build up to retirement years, and particularly that allocation of your prudential requirements, typically that plays your consolidated fixed income portion of a portfolio and well into your retirement, where that multi-asset income capability just gets you that slightly higher return over time. And we can see that when you look at the history of these funds relative to one another, the gap between money market and diversified opens, because those asset classes that one can incorporate through their return profiles gives you a combined outperformance over time. So hopefully you agree with my construct of how to use these funds in a portfolio construction for a client.
Yeah, so I agree with you. One of the interesting things we saw in specifically 2016 and 2017 to mostly 2018 as well, was that the additional return you got for stepping out of cash and money market and stepping into these funds were very low. There were periods in 2016 where your 1-year bank NTD and your 10-year government bond were yielding the same amount, right? So they were both yielding approximately somewhere in the order of 8%. Now, however, that gap between 1-year NTDs and 10-year bonds is over 4%. So what that means is that in 2016 and 2017 and those years, the reward for stepping out of cash, out of money market and a stable income fund, and taking the additional risks that you would in, say, a multi-asset income fund wasn't significant, right? It just wasn't structurally. And it's one of the reasons that we saw this massive growth in that short-term interest-bearing space, this enhanced yield space. It's because those funds gave you the same kind of returns as the diversified income type portfolios. Going forward for the next 12 to 24 months, I think that we're about to experience a situation where that's going to be quite a bit different, because suddenly you're getting significantly rewarded for taking duration risk, preference share risk, property risks, and those kind of things compared to your cash risks. So it's going to be interesting to see how these funds compare to each other in the next 12 months and what industry flows look like next year this time.
Sure. Albert, thanks very much. Appreciate you sharing your insights and time, and hopefully this has been useful for those that have dialed in to listen to our conversation. But before we end off, naturally, as mentioned earlier, we'd like people to submit their questions, and we will take them from here on out. Thanks very much. Okay, thanks very much again to everybody that's been joined us today. We've kindly been posed a few questions, and what I'll do is just read those off and pose them to Albert in trying to answer a few of the questions that we have received today. So Albert, maybe just one is related to market dynamics, just specifically around the 186 bond and its indicator. When the question asked here was, when I view this on the screen, it's red and sometimes it's green, and today it's green. Is that a good or a bad thing? I usually think green's good, but what's your view?
So the R186 has long been used as one of the benchmark bonds in South Africa. It was the 10-year bond for something in the order of 4 to 5 years. If that sounds strange to you, it is a little bit strange. When it was the 12-year bond, the 11-year bond, the 10-year bond, 9 and 8 years bond, it was all around that point that it was judged to be approximately the 10-year bond, because there was nothing else in this curve. So a lot of people watched it. One of the reasons the R186 is very popular these days is because our curve is so steep, right? The front end of the curve is sitting at around about 4%. And the R186 is sitting in the order of 7.5. So what it means is that as that bond, let's say, they call it either roll down or slide in the market, but as that bond comes closer to maturity, just the fact that its term is getting shorter will mean that it's probably going to have more green days than red days. A red day is good if you've already bought the bond. A green day is good if you've already bought the bond. A red day is good if you haven't bought it yet, you're still looking to buy it. So I suppose it depends on your perspective.
Okay. Just maybe sort of, I guess, a probability question. As we spoke about the extreme volatility we've seen in markets recently, which is really on the back of a hard stop of economic activity around the world, and particularly in South Africa, where businesses and people were stopped from moving around and economic activity happening, and we saw these extreme moves in property, bonds, equities. Just the question is, what's the likelihood of us seeing that again in I guess more specifically the short term? not asking you to forecast another 100-year story like we've seen, but maybe just related to what's the expectation for corporate credit and bond markets specifically in the next while, and that extreme event.
Yeah. So I think the shock and awe portion of this crisis is past, and we're now into, let's call it, the slow grind to normality. The question on everyone's minds is, how long does that take, right? Because when there's a vaccine out there and people can return to normal, yes, there'll still be some problems, and there'll be this massive debt overhang from this crisis. But to counter that, you'll have global rates at the lowest levels they've ever been. So we're now on the slow grind portion, right? That means that to a large degree, we're going to have to wait and see how these things turn out. It's unlikely that we'll see the same kind of market volatility that we saw in March and April. But as the commentator said the other day, there's more than one type of crash, right? The one type of crash is where the market falls by 20%. The other type of crash is where the market goes sideways for 5 years, right? So we may be in a position where markets, especially South African markets, go sideways for a while. And we'll have to see whether that's the case or not. That's significantly less likely in your fixed income markets. The rate of growth and rate of returns are relatively well known. But it is potentially true in the equity markets, and that effect might slide and go through to the credit markets a little bit as well, giving you some increased volatility there. But it's unlikely that we'll see the same types of events that we saw in March and April. We've already seen bank spreads come in. They spiked 40 points during March and April, and bank spreads on senior paper have already come in another 30 points. So they're only up about 10 points from prior to the crisis, which is a good indication of sentiment, both at the banks and people trading with the banks.
Thanks, Albert. So another question related to Diversified Income Fund. We spoke about the build-up of the expected return in the order of 8%, maybe a little bit lower, 7.5%. But the question is related to SA bonds. Do you expect bonds to do better than Diversified over the next year? So I guess where we've seen bonds blown off to and they've recovered, you've got a good coupon rate coming through in the bond market. So now that question is really contrasting, I guess. Does a pure bond fund beat Diversified Income Fund?
Mm-hmm. So from the bottom of the cycle, certainly, right? So if you had bought a bond fund on the 1st of April, over the following 12 months, the bond fund would easily have outperformed Diversified Income to a large degree just because bonds lost so much value. Also, Diversified Income actually has only about 10 to 15% bonds. It's got a range of other asset classes, but about 50 to 60% of that is cash, credit, those kind of money market instruments. So bond funds should, over the long term, outperform Diversified Income. But the reality of that fact is that the bond market was at one stage down on the at midday on the 24th of March. The bond market was down 24% from its peak. Where your multi-asset income funds were down only a couple of percentage points. So your bonds are significantly more volatile and more risky. But over time, they should outperform as well.
So I guess that the point there is that if you're going to make the asset allocation call yourself, there will be time when you can use a bond fund, or effectively you've got time and risk that you have to factor in. Okay, thank you. There's just one or two more, if we'll just take one or two. So again, relating to the bond market, what are the chances of capital loss?
So if you look at bonds in general, there's something in investment markets that's roughly termed by people the funnel of uncertainty. It's the rate at which your short-term returns effectively start approaching your long-term medians. And the lower the volatility of the asset class, the better those numbers are. For things like bonds, for example, there are very, very few 3-year periods in South Africa where bonds are down over a 3-year period in total returns, right? If you think about what bonds were down on the 24th of March, right, when it was down 25%. It erased about 2.5 years worth of bond returns over that period, but it was still up over a 3-year basis. So over a longer term investment horizon, the chances of losing money in bonds permanently is very, very, very low. With the caveat that if a country defaults, then that's certainly possible. But if you're in that kind of situation, then there's no safe haven for you at all.
Sure.
So barring that extremely unlikely event where a country stops paying its local currency debt, which doesn't happen often, losing money in a bond fund over a 3-year plus period is statistically very, very rare.
Okay. So thanks for that, Albert. There's just sort of the last 2 questions. Now, one is more related to sort of the technical nature of how fixed income funds are priced. So variable unit price versus a money market fund that has a constant unit price of 100. Maybe just want to talk us through, why would you have 100 in money market or a constant unit price? At month-end, distributions are paid out or reinvested. You'll see the price movement and then, back to 100. Versus something like diversified income, which on a daily basis will have volatility due to its underlying dynamics. Do you maybe just want to cover those 2 concepts for me?
Okay, so money market funds, as I said, were created for people that effectively just want to step out of a bank into something that gives them a little bit more. And therefore their behavior looks very similar to what a fixed deposit would look like. Money market funds are in the position where regulatorily they're allowed to keep their NAV, their net asset value price, or the unit trust price fixed at 1. So they're allowed to keep it fixed, regardless of the underlying variation in the pricing. It stays at 100, unless there's credit losses or those kind of events. The assets in a money market fund are valued at accrual rather than mark to market, which means that the money market fund is the perfect vehicle for anyone that wants short-term, not quite transactional. These funds aren't intended to be transactional, but if you have a situation where you're putting the money in today, you're not sure if you're going to need it in a week or a month or 2 months, the money market fund is kind of the right home for it. There are corporate clients that, for example, use the money market fund for import-export businesses or stock cycles. So they'll during the course of the month, they'll put a lot of money in the money market fund. At the end of every month, they have to withdraw it to buy new things. We've just met with a potential client a while ago who, according to their auditing regulations, have to prove the liquidity of the underlying investments, which means at the end of every audit year, they have to withdraw all of their money from the fund, keep it in their bank accounts for a couple of days, and then deposit it back again. For those types of clients, right, a money market fund works well because there's zero day-to-day moves in the unit price, right? To get that, money market funds are severely restricted in what they're allowed to buy. No instrument longer than 13 months, weighted average life 120 days or 4 months, and a weighted average modified duration of 90 days or 0.25. And because of that, they get the benefit of keeping a fixed price. So the other funds don't quite work like that. They work on what's called a pass-through principle, right? Effectively, all returns, all movements, all mark-to-market valuations, everything gets passed through to the end client, less the total TER on the fund. So it's effectively a situation where every price move gets reflected on a relative basis in the portfolio. For something like stable income, that can be mean that most days stable income is up 0.02%. Occasionally it's flat, and then occasionally you'll see a day where you're down negative 0.05 or negative 0.1, those kind of effects. But on average, most days are up 0.02%. When it comes to a situation like an equity fund, you have volatility that's the same as the underlying equity index or similar to that. What that means is that for something like stable income, we tend to say, well, if you have a investment horizon of say 4 months or longer, whether it's 4 months, whether it's 6 months, depends on the time and how conservative or risky the client is, the nature of the advisor. But if you've got a longer investment horizon, then stable income is much more suited for your needs. If you, however, have a much shorter investment horizon, then even the somewhat infrequent volatility of the stable income fund might be more than some clients can handle, and they want to sit in a money market portfolio where by regulation the unit price stays at 1.
Okay. Thanks, Albert. Last question. I know we've taken a lot of everybody's time this afternoon, but hopefully it's been interesting. So last question actually relates to, I think, a challenge that most advisors have, and particularly their retired clients who are taking an income potentially out of something like stable income fund or a money market fund. And now these, as we've spoken about, interest rates have come down quite dramatically. Clearly there's a reduction in income. Now investors need to supplement that or complement, or try and get back to a higher level of income. What's the consideration of how they do that without taking significant risk? Because obviously what you're trying to do is protect capital at the same time. So I know that's a very difficult answer, but please have a go at it.
So it depends, it varies by client, right? So if you only need a little bit of extra above money market, right? If 5 is not enough but 6 is, you buy stable income. If 6 is not enough and you need closer to 7, you try and look at SA income. If you want those kind of returns, but you're more comfortable with term and certainty, and maybe doing something a little bit different, and then you can think about buying one of the government bonds. So the R186 we mentioned earlier, it matures in 2026, end of December, or 21 December 2026, and it's yielding about 7.5%. And that's the return you will get in that instrument for the next 5 years, right? The instrument is going to be volatile. The distribution payments from that is only once every 6 months. You're going to have to buy it through a share portfolio, and it's a little bit harder to understand. This is maybe for a more sophisticated type client, but we have been telling clients to maybe if they want to augment or supplement the money market or a stable income type income, then they could think about either moving to SA income, where we in effect buy the bonds, or they can just say, well, we'll take stable income or money market, but we will also buy the bonds on the side, and that will depend on the nature of the advisor or the client.
Sorry to interrupt. It's an important point you say. So now it depends how you're accessing. If we make the assumption that most people are building their income portfolios on a platform, be it a list, then yes, you probably won't have that functionality of buying in a securities portfolio. But what you could then consider doing is in combination of stable income fund and SA income fund, and blending them, or even a component of diversified income, just so that you don't have them all in one bucket. You actually separate it out and get a blended return.
You can even consider buying a bond fund, right? The yield on bond funds are somewhere in the order of 9% at the moment, a little bit higher than that. It's volatile, certainly, but as we learned earlier, over extended periods of time, bonds do relatively well, right? So you may want to decide, you know what, I'm going to buy a money market fund or a stable fund or SA income fund, but I'm going to buy 10% bonds as well, because there's a predictability to the bond, to bond buying that's not available in anything outside of fixed income. I mean, we know we have a general idea of what the yield is on property and on property funds or on equity funds, but their future return stream is essentially unknown, whereas the future return streams in a bond fund is actually quite known. So supplementing an income portfolio with something like that is definitely something you can do as well. And from an asset allocation perspective, we have been doing that to some extent within diversified income. So diversified income has most of 2018 and part of 2019 sat with a cash allocation, so cash and credit allocation of between 60 to 65%. Now with the drop in effectively JIBAR and cash and credit yields, what we've been doing is we've been buying more bonds. So we're currently holding a higher structural weighting of bonds than we have in the past. So those are all things that people can think about doing. The reality, however, is that we are now starting to confront, not quite yet, some of the similar problems that savers and retirees have faced in Europe and the US and a lot of these countries, and Japan now for decades, which is low cash rates at the front end of the curve. And one of the results we know from that is that clients are forced into more risk-taking. I'm not going to comment on whether that's a good thing or a bad thing. For some clients, it might be a good thing. For others, it might be bad. But we know that that is what they do. We know that clients move out of the low-risk products into the higher-risk ones. So it's unfortunately the only way you're going to get there.
Sure.
You'll just have to pick which risk you're comfortable with.
Yeah, and stomach the volatility that comes with it to get the income. But maybe the capital is, the income's more important than the capital stability in the short term. Albert, thanks very much. I appreciate you sharing the insights and taking the time. And to everybody that tuned in, thanks for the questions and thanks for taking the time to listen to our video and podcast. We know that there's a lot going on in the market at this stage as people sit at home, probably learning, investigating, trying to uncover how things really work. And we know that there's lots on offer out there. So thanks for taking the time with us. We'll be doing more of these and hopefully you'll dial in again. Thanks very much and good afternoon.